Promoting financial education is especially important as the global economy continues to experience extraordinary turbulence. In the U.S. and abroad, the need has never been greater for initiatives that help consumers learn to manage their money wisely.
Which mortgage loan product do you think carries the lower price tag? A fixed-rate mortgage loan advertising a prime market interest rate supplemented by a 2% loan origination fee and $3,500 in closing costs, or the same loan offered at 1% over prime rate with no origination fee, but $2,500 in closing costs? In the case of credit cards, which offer seems better to you? One with a periodic rate of 10.9% and over-limit fee of $25, balance transfer fee of 3%, and late fee of $29, or one with a periodic rate of 11.5%, and over-limit fee of $25, balance transfer fee of 2%, and late fee of $25. Did you look at the default rates? Were there initial teaser rates? Are the interest rates fixed or adjustable? The scenarios I just presented to you may sound complex, but these are questions consumers often face when making day-to-day financial decisions. The concern that consumers are in the dark when it comes to understanding terms of credit has become increasingly apparent. Lenders have exploited consumer deficiencies in ways that have resulted in unethical practices such as predatory lending. In fact, these unethical practices are a contributing factor to the recent economic recession. The downturn has often been referred to as the subprime mortgage crisis. One reason for this is the fact that individuals were going to mortgage brokers and being presented with offers they couldn't afford, contracts they were not even eligible for, or agreements on terms worse than what they were actually qualified for. For example, one recurring issue is predatory lending, specifically adjustable-rate mortgage loans. When young home buyers in the early 2000s went to apply for a loan, they entrusted lenders who highlighted the beginning fixed low rate on adjustable loans. However, lenders did not disclose that after 2 years, the rate was no longer fixed and often jumped to levels that individuals could not afford. Soon, home buyers across America were primarily paying interest rather than building any equity into their home. As the debt piled on home buyers who could no longer afford the big house that Mr. Lender said could be theirs, defaults started coming in daily. As a result, the subprime mortgage crisis was fueled. However, predatory lending is only one of many unethical procedures practiced by unregulated mortgage brokers whose goal was money rather than honesty. In light of the recent economic recession, I propose to explore the increasing rate of financial illiteracy in America over the past 2 decades. I want to investigate the mortgage crisis, how together the complexity of interest rates and unethical procedures of mortgage brokers lured individuals into contracts they did not understand or could even afford. I want to focus on the original source of financial education, our youth. Have high school curriculums unprepared individuals for financial responsibilities? Could the lack of financial education have triggered the greed of brokers, thus being an underlying source for the recession? The government has clearly gone after those who have unethically lured consumers into debt, but what has Congress done in response to the rate of financial illiteracy in America? The purpose of this essay is to examine how financial literacy is an important factor contributing to repeated economic instability. The scope will be limited to youth of America in order to confine the research over the past 2 decades. The findings of this essay will suggest the need for focus on financial education in school systems. The result will create financially knowledgeable consumers who will become less vulnerable to terms laid out by future participation with lenders, creditors and financial institutions alike. To answer these questions, I will need primary information on financial literacy in America over the past 2 decades and the recent subprime mortgage crisis. Secondary information will include government programs that have impacted financial education and background on both lending practices and interest rates of mortgage brokers. I have already compiled 5 sources that cover at least one of these areas. Out of these 5 sources, I have been able to find an array of information regarding financial literacy in the past 2 decades. In a paper presented at an international conference, Federal Reserve Board member, Jean Hogarth defines a financially literate individual and the impact of financial literacy on economic development. She gives specific programs currently in place for financial education and discusses a case study conducted in a local community that discovers the impact financial education has on the growth and stability of local economies. The National Endowment for Financial Education held a symposium that addressed efforts to increase the financial literacy of young Americans. A report on the conference examines useful statistics relating to the issue of financial literacy and provides information on current and potential education programs presented. A Nation Still at Risk is a journal article by Joe Edisakman that provides statistics surrounding a period survey conducted by the Federal Reserve to assess financial literacy in high school seniors. These three sources provide groundwork to understanding financial literacy, what programs have been implemented both before and after the recession, and they provide statistical data that analyzes both financial illiteracy and its effects on the American economy. In order to examine the impact of financial illiteracy in light of the recent recession, I consulted multiple articles that defined the subprime mortgage crisis, what unethical actions were taken to lure consumers in, and what those lending practices actually entailed. A lengthy article published by the Yale Journal on Regulation examines how the original standard disclosure for the cost of credit, annual percentage rate, has rapidly declined. As a response to the consequences of more complex credit terms, the authors draw on financial literacy to rationalize the need for future reinstating of standards in lending disclosure. Consulting these sources has laid a major foundation to my research process. While financial illiteracy has impacted the majority of the U.S., I believe that an analysis predominantly targeted at the youth of America would give my essay a narrow concentration without compromising the questions I have proposed. Furthermore, the source of the illiteracy is our education as youth, which encompasses all individuals.
Regulations were gutted for the sake of a quick profit at the expense of a healthy market. People bought homes they knew they couldn't afford, from banks and lenders who pushed those bad loans anyway. And all the while, critical debates and difficult decisions were put off for some other time, on some other day. Well, that day of reckoning has arrived, and the time to take charge of our future is here.